Alphabet plans to double their capex spending toward AI compute capacity. This comes over growing market concern that AI tools could replace traditional software products. For more, we're joined now with Angelo Zino, senior equity analyst at CFRA Research. It's good to have you join us today, sir. Thanks for taking the time.
Great, thanks for having me.
So I'm just wondering, first of all, before we get into some of the details that Alphabet announced, what do you think investors are reacting to in their latest earnings report?
Yeah, I mean, you kind of look at the decline here today. I mean, listen, a couple of things here. One, I mean, this was a name that was really on fire. It was, I think, the best performing of the Mag 7 names here, since April of last year. So you kind of look at the multiple. It's trading about a 25% premium to Microsoft. So it definitely needed to cool down a little bit. And the company gave the markets a reason to cool down. That was essentially the capex number, which was significantly above our expectations for about 125 to 130 billion, and significantly above the streets at about 115, 120 billion. So you look at the capex plans of about nearly doubling here in 2026 versus last year's levels. That's going to take a big hit in terms of the free cash flow assumptions in 2026 and into 2027 theoretically. And that's really what's driving the stock here lower today.
Yeah, because that's record spending, I believe, this latest capex in 2026 to kind of build out that AI compute for DeepMind. I'm wondering, obviously investors a little, as you say, a little cautious about it. How should they be reading into it?
I think the positive takeaway here from Alphabet is the growth story. It just looks better today than it has in a very long time. I mean, you look specifically at the cloud number, grew their cloud business by about 48%. Our view was going to be somewhere along the lines of 32 to 33%. So you've got this nice, really upward inflection in terms of that cloud business. Not to mention the backlog number that they provided at about 240 billion, up 55% sequentially, essentially doubled here over the last 6 months or so. So they've got some really good visibility in terms of that cloud business over the next 2 to 3 years, which is why they're spending so aggressively. I think the other positive takeaway is, of course, their core business outside of cloud, so search specifically, is growing much faster than we anticipated. There are going to be new ways for them to charge in terms of the advertising side of things, which is also a much more profitable business than cloud at this point. So they're running on full cylinders at this point, which is really why you're getting the spending that you're getting.
Yeah, and this aggressive spending, I take your point, but at the same time, how long do you think investors should wait before they start seeing results from this aggressive spending?
Well, I think the good thing, at least from Alphabet, and listen, I mean, they've been increasing capex significantly over the last couple of years, as has Meta and some of these other hyperscalers. But you have seen some successful monetization from Alphabet as well as others. I think the problem is, a lot of this stuff is going to be front-loaded in nature, and it is going to put a dent in terms of the free cash flow assumptions. But it is translating to significantly higher revenue across the board in many respects, specifically from Alphabet's business on the cloud and on the search side. And I do think that continues at a higher level here in 2026. So it's not something you're going to have to wait years on, but in the same respect, in terms of maybe getting to that free cash flow growth levels that we had seen in years past, it's something that it's probably going to be on the sidelines here as they continue to aggressively invest for the future.
Okay. It's interesting what we've been seeing lately in the software sector, like that sharp sell-off, as investors are kind of worried that AI is going to replace some of that software that we have been using. I wonder where you think Alphabet stands in all of that noise.
Yeah, I mean, I think in some respects, Alphabet on the call last night was trying to be very supportive on some of the destruction that you've seen from these SaaS-oriented vendors, in the sense that, hey, listen, there are going to be opportunities for many of these players that are able to actually create some great tools on the agentic AI side. It is going to be, I think, a very selective market. I think there's a lot of stickiness in some of these companies out there. A company like Salesforce, for instance, is a name that we do like a lot. But in many respects, I mean, clearly there is going to be increased competitive pressures. I mean, whether it be from the OpenAIs, Anthropics of the world, or even the Alphabets of the world themselves, that's going to put pressure on a lot of these SaaS models. So, do we think there is risk out there, and do we think kind of this this multiple compression you've seen here over the last couple of weeks in software is justified? To some extent, yes, but also in some respects, we do think there are opportunities out there to be had.
I know we touched on this talking about, Alphabet, and you saying maybe investors don't have to wait too long to see some kind of results from this heavy spending. But I wonder what investors think, or what you think investors should think about the balance between, heavy AI investment and actually like near-term profitability.
Yeah, I mean, listen, I think the biggest risk for the market when you start thinking about all this spending is one, I mean, listen, you've got Alphabet spending at this higher level now, and it'll be interesting to see what Amazon says after the close at this point. But in some respect, they really set a higher bar in terms for others to, in many cases, also increase their capex plans. As you continue to aggressively increase capex plans, the concern is at some point in time, does that supply start, to become imbalanced with the actual demand that's going to be created? And when we get to a point where there is that supply imbalance, tilting more to the supply side, that creates a very risky proposition to these companies that are really kind of building up a more fixed cost structure on their side. But we're not there at this point. I mean, we're at a point right now where demand looks like it's very strong in nature. So as long as we're in that environment, I think you're going to be okay. But again, I mean, that is the risk in this environment. It's the fact that you've got a more fixed income structure from these companies. And to this point, at the very least, they've done a pretty good job in offsetting some of those higher costs by leveling off headcount and kind of managing the OPEX on that side.
Okay, we will leave it there, but appreciate your insight. Thanks so much for joining us today.
All right, thanks for having me.
That was Angelo Zino, Senior Equity Analyst at CFRA Research.